It's 7:14 a.m., and Linda is staring at her payroll portal, coffee getting cold. She's 61, makes $165,000 a year, and just discovered she might be able to stash away an extra $11,000 this year. But there's a catch. Actually, there are several. And if she doesn't understand them by January, she's going to lose a tax break she's had for 20 years. Let's break this down. I'm your host, and this is Money Moves Daily. Today we're covering one of the most significant changes to retirement savings in years, and a 4-year window that closes sooner than you think. Here's the headline. If you're between 60 and 63 years old, you can now contribute up to $35,750 to your 401k in 2026. That's not a typo. $35,750. It's called the Super Catch-Up Provision, and it came from SEC Year 2.0. And this is the part that catches people off guard. If you earned more than $150,000 last year, there's a mandatory Roth requirement that changes everything. We're going to cover exactly who qualifies, what the numbers mean for your tax bill, and how to actually take advantage of this before your 64th birthday locks you out. First, some background. For years, the IRS has allowed workers over 50 to make catch-up contributions to their retirement accounts, extra money beyond the standard limits. The logic was simple. People in their 50s and 60s often have higher incomes, fewer expenses, kids are grown, mortgage might be paid off, and a shorter runway to retirement. More time to save when you're young, less time when you're older. The catch-up contribution was designed to help level that playing field. In 2026, the standard 401k contribution limit rises to $24,500. That's for everyone, regardless of age. For workers 50 and older, there's an additional $8,000 catch-up limit. That brings your total potential contribution to $32,500. But here's where SEC 2.0 changed the game. Starting in 2025, workers aged 60 to 63 got access to an enhanced catch-up, the Super Catch-Up. The Super Catch-Up adds $11,250 in contribution room. That's $3,250 more than the standard catch-up allows. Important distinction here, the Super Catch-Up replaces the standard catch-up. It doesn't add to it. You get one or the other depending on your age. So if you're 62 years old in 2026, your maximum 401k contribution is $24,500 plus $11,250. Total, $35,750. But the moment you turn 64, that window closes. Your catch-up drops back to the standard $8,000. No exceptions. This creates a 4-year window. Ages 60, 61, 62, 63. 4 years of enhanced savings potential. After that, gone. Now, here's where it gets complicated, and honestly, this is the part that catches most people completely off guard. Starting in 2026, if you earned more than $150,000 in FICA wages the previous year, all of your catch-up contributions must go into a Roth account. That's not optional, not a suggestion, it's mandatory. The IRS built this requirement directly into SEC Year 2.0. So what does this actually mean in plain English? Let me walk you through 2 scenarios. Scenario 1, you're 61, earn $120,000. Under the threshold, you can make your catch-up contributions to either traditional or Roth, your choice. Scenario 2, you're 61, earn $170,000. Over the threshold, your catch-up contributions, all $11,250 must be Roth. The base $24,500, that's unaffected. You can still split that between traditional and Roth however you like. Only the catch-up portion is restricted. Now, you might be thinking, okay, Roth isn't so bad, and you're right. There are real advantages. But let's be honest about what you're giving up. With traditional contributions, you get an upfront tax deduction. That $11,250 reduces your taxable income immediately. Real money saved this year. With Roth, you don't get that deduction. You're contributing after-tax dollars. The benefit comes later. Tax-free growth and tax-free withdrawals in retirement. Quote from Fidelity, You'll lose out on the upfront tax deduction you may have had previously, but you can potentially benefit from the advantages Roths can offer, including tax-free earnings and withdrawals. Here's the honest version. Nobody, not your accountant, not Wall Street, not your favorite finance podcast, knows exactly what tax rates will be in 20 years. What we do know is this. Roth accounts have some genuine structural advantages: no required minimum distributions, tax-free inheritance for your heirs, flexibility in retirement income planning. Savant Wealth puts it this way: for those who expect to remain in a high tax bracket during retirement or want to leave assets to heirs, Roth contributions can be beneficial. But here's where people get burned, and I want to be careful here because this trips up even sophisticated investors. If your employer's 401k plan doesn't offer a Roth option and you're a high earner, you cannot make catch-up contributions at all starting in 2026. Let that sink in. You could lose access to $8,000 or $11,250 if you're in the super catch-up window of tax-advantaged savings. Not because of anything you did wrong, simply because your employer's plan isn't set up for Roth contributions. So here's your first action item. Contact your HR department now. Confirm that your plan offers a Roth 401k option. If it doesn't, ask when they plan to add one. Many employers are scrambling to add Roth options before January 2026. The IRS gave plan administrators until the end of 2026 to make amendments. But you need to know where your plan stands. Now, let's talk about who this really benefits most. And let me be clear, this isn't a one-size-fits-all opportunity. The Super Catch-Up was designed for people who've perhaps delayed retirement savings. Maybe you prioritized paying off debt, or raising kids, or building a business. Now you're in your early 60s, you've got the income, and you need to catch up. Literally, that's the whole point. Let's run the numbers. If you max out the Super Catch-Up for all 4 eligible years, ages 60 through 63, and your investments grow at 7% annually, that's $45,000 in extra contributions over 4 years, not counting the base limit. With compound growth, that could mean $80,000 to $90,000 by age 70. Now, your specific situation matters enormously here. Your tax bracket, your retirement timeline, your other income sources, these all affect whether traditional or Roth makes more sense. If you're in that transition zone between ages 60 and 63, earning around that $150,000 threshold, it's worth considering a conversation with a qualified tax advisor. Because here's the thing. The $150,000 threshold is based on your prior year FICA wages. That's wages subject to Social Security and Medicare taxes. If you know your income might fluctuate, maybe you're considering a sabbatical or reducing hours before full retirement, that threshold becomes a planning opportunity. Some planners suggest, and you'd want to verify this with your own advisor, that timing your income around that threshold could affect whether you're forced into Roth or not. Now, I want to reframe something, because a lot of coverage treats the mandatory Roth rule like it's a punishment. It's not necessarily. Roth accounts have no required minimum distributions during your lifetime. That's significant. Traditional accounts force you to start withdrawing at age 73. If you don't need the money, Roth lets it keep growing, tax-free, for as long as you want, and when your heirs inherit it, they get tax-free withdrawals too. For people who've accumulated substantial wealth and want to maximize what they pass on, Roth can actually be the better vehicle, even if it means paying taxes today. Here's what I'd suggest considering. If you're in the 60 to 63 window, don't leave that $11,250 on the table unless you absolutely have to. Even if you have to go Roth because of the income threshold, those contributions will still grow tax-free. That's not nothing. That's potentially decades of untaxed growth. Check your 2025 W-2 carefully when it arrives. That FICA wage figure determines whether you're above or below the $150,000 threshold for 2026 contributions. And don't forget, IRA limits also increased. The catch-up contribution for IRAs rises to $1,100 for people 50 and over. Total limit, $8,600. Important distinction, the mandatory Roth rule only applies to employer plans like 401ks. IRAs are not affected. You can still make traditional IRA contributions regardless of income. If you're coordinating multiple accounts, 401k, IRA, maybe a spouse's plan, it might make sense to think of your total contribution strategy as one unified approach rather than separate decisions. If this kind of detail is useful to you, hit subscribe. We break down these changes as they happen, not after you've missed the window. Let me walk through one more scenario, because this one catches a lot of people by surprise. Say you're 64, you just missed the super catch-up window. Your catch-up limit drops back to $8,000. But here's the thing. If you earned over $150,000 the prior year, the mandatory Roth rule still applies. You're past the super catch-up window, but you're not past the income threshold. The rules apply at age 50 and older for catch-up contributions, and the Roth mandate kicks in based purely on income, not on which catch-up tier you qualify for. So if you're planning retirement in the next decade, it's worth mapping out each year. What's my age? What's my expected income? What accounts do I have access to? That forward planning, ideally done with a qualified advisor who understands your specific situation, can help you time contributions for maximum benefit. Every year matters differently. Here's what it comes down to. SEC 2.0 created a genuine opportunity, but also genuine complexity. The super catch-up is real. The mandatory Roth rule is real. The 4-year window is real. If you're in that 60 to 63 window, this is worth your attention, not panic. Attention. Informed action beats reactive scrambling every time. Check with your HR. Review your income, top-tier advisor. And remember, this content is educational, not financial advice. Your situation is specific to you. I'm your host. This has been Money Moves Daily. We'll see you next time.